Today, Governing Council maintained the policy interest rate at 2.75% following 7 consecutive cuts.
Welcome back to the show. My name's Mark Nixon. The Bank of Canada held its policy rate to 2.75%. No interest rate cut, no help. They've cut interest rates at every single policy meeting for 7 consecutive policy meetings. But this time, they didn't do anything. They literally are captured in fear. They don't want to touch anything. And it's like, our economy, is it better? Is the jobs market better? And is everything looking great? Why wouldn't they continue to cut interest rates? Well, we're going to get into this today. What does it mean for your mortgage? And is there relief in sight? Maybe possible. But here's the catch. And we're going to get into this detailed analysis so that you are ahead of the curve. If you haven't already subscribed to my channel, probably should so that you don't miss any of my valuable updates. Also, smash that like button. It helps the algorithm. And that's the best way you could support the channel. Let's get into it. And you are not going to believe what Tiff Macklin said next.
The Canadian economy ended 2024 in good shape.
What? It was a what? I don't think it was in the greatest shape like Tiff Macklin just painted. Who remembers this?
About the disconnect between the positive news that the numbers are showing about the Canadian economy and what people are feeling. He talked about how Canadians are feeling. And that's a really important economic point. A lot of economists have been talking about the vibe session and the fact that Canadians just aren't feeling good and that is having real economic consequences. And the Canadian economists making that point are right, that there is a disconnect between the real economic the really positive economic news, the fact that the Canadian economy does appear set for a soft landing, that's good news. But Canadians aren't feeling it, and that is shaping their economic behavior in ways that are not great for the Canadian economy.
Yeah, so Chrystia Freeland, that was back in December, and they talked about this vibe session. So they offered everybody this beautiful tax holiday on junk food so you could get your rotisserie chicken 40 cents off. You buy 25 of them and you get the 26 for free. And former Bank of Canada Governor Stephen Polo said, "We're in a recession." That was back in December. Exactly. So what Tiff Macklin's saying today, I don't know what kind of fairy dust he's been taking, but we've been doing not so great as an economy in Canada for quite some time. This is not just a recent phenomenon. Ever since Justin Trudeau and the Liberals took office back in 2015, business investment per capita has not improved. It's actually declined significantly. So just to think that we could potentially have another Liberal government for another 4 years, this trend is not going to reverse itself. I want you to understand where we are at. We have to look at history in order to understand. So here's a chart that shows the last 20 years of interest rates, and you'll see from 2009 all the way to 2022, the interest rate was below 2% throughout that entire period. Until recently, we raised at the fastest pace in Canadian history to 5%, and now the rate has dropped down to 2.75%. But why did Tiff Macklin, after 7 consecutive rate cuts, decide to pause this time? We're going to have to look at our friends down south. And here are the interest rates for the last 20 years in the United States. Check out the most recent. The US went from 5.25. Now they're down to 4.33. See, that is significantly higher than the Bank of Canada, which they're at 2.75. You see, go with the US. So the only way for the Bank of Canada to significantly drop the interest rate, we need the US to start dropping the interest rate. In 19 days, the US is going to have an interest rate announcement, and there's a 92% chance that there is zero interest rate cut in the US. And that is something that the Bank of Canada considered for their interest rate announcement that just occurred. See, by the Bank of Canada pausing cutting interest rates, it actually helped strengthen the Canadian dollar. The US dollar is also weakening at the same time, as well as the price of oil has rebounded in the last week. So if Tiff Macklin decided to continue to cut interest rate, it would weaken the Canadian dollar. And guess what? Inflation in Canada would go up for everything that's imported into Canada. Let's take a look at the WTI crude. As you can see that it dropped significantly when China and US went at each other with their 125% tariff, and now it's gone all the way up to 275. Basically, shipments from China and the US have halted completely. That caused a significant drop in the price of oil, but it has since rebounded slightly. Now, this next announcement by Tiff Macklin's going to really piss you off.
The very near-term outlook for inflation is relatively clear. The elimination of the consumer carbon tax on April 1 will reduce CPI inflation by about 0.7 percentage points for 1 year.
Oh, what? Do you hear that? 0.7% reduction in inflation for 1 year. Do you guys know how significant this is? That's a 30% reduction in inflation. And here's a chart of what it looks like. So you could see that we have 2% inflation April of 2025. And then for an entire year, it drops down to 1.5% inflation. Ladies and gentlemen, you can't make any of this stuff up. So you're telling me that the Liberal government has been telling us for the last 9 years that the carbon tax does nothing, absolutely nothing to inflation. Just this 0.15% it adds to inflation. But then when it gets removed, it drops inflation by 30% for an entire year. This is incredible. And on top of that, we just had Mark Carney come out and say that the carbon tax only reduced emissions by 6%. So it basically did absolutely nothing. And that is provided by their numbers. Their numbers 6%, but in reality, it's probably 0%. So they've imposed this crippling carbon taxes for so long. And now we actually get to see with our very eyes that the carbon tax destroyed our economy and did absolutely nothing to save the planet. Oh, you can't make any of this stuff up. So Tiff Macklin talked about 2 possible scenarios, but he said there could be an infinite amount of scenarios that could happen to the Canadian economy. The first scenario, however, it has Donald Trump backs off and he removes all the tariffs on Canada. We have the drop in inflation because of the removal of the carbon tax. And he says the damage is already done because of Donald Trump's flip-flop on the tariffs. And that's scenario 1. And what does the economy look like? Then there's scenario number 2, in which Donald Trump does the full-fledged tariffs. And what does everything look like? Let's get into it. Let's read scenario 1. Trade policy uncertainty weighs on activity. GDP stalls briefly in the second quarter of 2025, then expands at a moderate pace, resulting in persistent excess supply. Inflation drops below target for the rest of 2025 and in early 2026 due to both excess supply in the economy and the removal of the carbon tax. This occurs despite an upward pressure on prices from the few remaining tariffs. Inflation then averages out to 2% for the remaining of the scenario. Let's look at the chart. So the blue line is scenario number 1. We're going to get into scenario number 2, which is the yellow line. But in scenario number 1, you'll see in the second quarter of 2025, we have zero growth, and then it grows back up to just over 1% growth. But if we take a look at the yellow line is scenario number 2, we go into a massive recession, and that recession goes for all of 2025 and into 2026. It will be a year-long recession, and I wouldn't even call that a recession. 4 quarters, a whole year, that looks more like a depression to me. Now, the Bank of Canada provided us their inflation analysis based on different scenarios. So scenario 1, where there's no tariffs, everything goes back to normal, inflation drops down to 1.5, and it stays there for an entire year. This is probably the best scenario because in this case, the Bank of Canada could lower its policy rate significantly. They could give everybody relief when they go and renew their mortgages. That's why when I see Mark Carney say he's going to retaliate and put all these tariffs against the US, it's terrifying because as a result, if we do retaliatory tariffs, it will increase inflation. And as a result, the Bank of Canada will not be able to cut interest rates into that type of environment, costing you significantly more on your mortgages. And if we take a look at scenario 2, where we retaliate, as I just described, we see a much different picture. The only reason that we see a drop in number 2 at the beginning is because of that wonderful carbon tax. It's making a massive difference when it comes to inflation. But as you can see, after the carbon tax is gone, like the effect of it is gone, the inflation rate goes way up, all the way up to 3%. And these are modeling. They actually have no idea how quickly and how far inflation will actually happen. Their forecasting was wrong before. Remember when they said inflation was just transitory and it would last a couple months? Just at the point where inflation is near the target of 2%, but it took us 3 years to get there. Think about that. And they kept telling us it's transitory. They don't know what's going to happen. They just do these advanced modeling and try to tell us everything's going to be fine. But in reality, inflation could take off even faster and harder. And that is something we don't want. So yeah, electing Mark Carney and he's going to retaliate. Our number one enemy right now is the US. No, our number one enemy is our Canadian government. And if we go after the US and start a trade war, it's going to significantly impact you. So for reference, let's look at scenario 2. Canada's GDP contracts over the next year due to tariffs and adverse effects of uncertainty. Growth continues to recover around 1.8% in 2027. Inflation goes around 2% through the first quarter of 2026, and the removal of the consumer carbon tax and the ongoing economic slack roughly offsets the impact of the tariffs. Inflation then rise above 3% for the second quarter of 2026 due to the impacts of the tariffs. It then gradually declines to 2% target in 2027. Do you see what I'm saying to everybody right now? And the thing is that the inflation skyrockets higher. It's not from Donald Trump imposing tariffs on Canada. It's actually on Canada imposing tariffs on the US. That's right. It's our own inflation that our government creates by retaliating. And guess what? Retaliating against the US is a losing battle because we can't win a trade war with the United States. Here's a chart that compares each scenario, but I want to say, we have to pray that Donald Trump doesn't have any funny ideas and imposes these crippling tariffs on Canada, because if we go through scenario 2, not only do we have economic destruction and our GDP goes negative, we go into that massive recession, but also inflation skyrockets higher. And guess what? That means not only are you losing your job, but prices are also skyrocketing higher. It's called stagflation, and it is the ultimate worst scenario that Canada could go through. Let's hope it doesn't go to this. And here's a chart that shows the GDP growth over the period. And if you take a look at the first component there, it says GDP average annual growth in 2025 in scenario 2 is only 0.8%. But check out 2026. Yeah, negative 0.2. And these are rough estimates. It could be much, much worse. The majority of Canadians do fixed term mortgages. And so fixed term mortgages are priced on the 5-year GOC. And the 5-year GOC right now is 2.734%. Usually you have to add a 1 to 1.25 premium on top of the 5-year GOC to determine what your mortgage rate would be. So right now the mortgage rate is around 4%. Where is the 5-year GOC going to go? That's a good question. During a recession, which is not out of the question, and usually the US and Canada enter a recession concurrently together. And the US has a 50% chance, that's the market, that the US enters a recession this year. If there is a recession, the 5-year GOC will be going down and Canada will be able to secure lower mortgage interest rates regardless of what the Bank of Canada does in their cutting cycle. So that's something to consider. And that's why at the beginning of the episode, I said there is some possible relief that could be coming for people that are renewing their mortgages, but we have no idea what's going to happen. And guess what? If there's a recession, that is not a good thing, even though it is good if you are able to maintain your job and you have a secure job, you'll be able to renew your mortgage at a significantly lower amount. However, there's going to be tens of thousands of people that are going to lose their jobs. So it doesn't matter how low an interest rate is. We need a strong economy. So that's something to consider. Let's go back to this chart. We're at 2.75. The neutral rate is at basically 2.75. The rate is not stimulative right now. It's just in neutral. And right now, analysts anticipate, like all of the major banks only believe the Bank of Canada will cut interest rates by 50 basis points by the end of this year. And they're probably going to do it in the June and July interest rate announcements, or potentially they'll do it in September. We don't actually know what they're going to do, but it's pretty scary to think that all of the major banks only believe that interest rates will be cut by 50 basis points. That is it. So we'll end the year at 2.25%. There is just so much uncertainty with interest rates right now. That is one of the reasons why you should probably subscribe to my channel, because I'm going to continue to look at the information and provide everybody with important updates. Now I want to briefly look at the Canadian real estate market, all of Canada as a whole. If you take a look, residential new listings, we are near the peak amount right now. Take a look at the average price of a home in Canada. From peak, we're down like 35% from peak. It peaked out at 825. Today we're below 700,000. And what's very interesting is where are the prices from a year ago, depending on each market. The two areas that have the highest real estate prices in Canada are BC and Ontario. And those are the two markets that we've seen a significant decrease in the value of real estate. The rest of the provinces are seeing increases. And guess what? The two most valuable provinces and that are seeing a reduction in the real estate values has actually pushed the national average down. Look at Canada, it's pushing everything down. That's how significant this is. And for some people to think about this is a lot of people retire or they go, you know what? These markets are too expensive. So they'll sell in BC or they'll sell in Ontario and they'll move to more affordable markets. So the first markets to start declining are actually BC and Ontario. And then it starts affecting smaller markets because that money is no longer flowing to the other markets. That's something to think about. If you made it to the end of this video, you are absolutely awesome. I'm obviously going to provide lots of updates because this is a rapidly evolving situation. And as the Bank of Canada describes, they really don't know what's going to happen. They're actually stuck in fear. That's why they're like, oh, we're not going to put the gas pedal down. We're just going to lay off the gas pedal. We're not going to put the brakes on. We're just going to do nothing and see what happens. Canada, we have a massive election that's happening in the next 2 weeks. Go out and vote. And guess what? You're going to want to vote for change because after 10 years of the Liberal government resulting in record inflation, the fastest rise in interest rate in Canadian history, everything that's happened to our economy in the last 10 years, Canada, it's time for change. We'd love to hear from you in the comment section. Thanks for watching.